Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. In this video, I'm going to show you a technique for trading gaps from the long side. We're talking about looking for monster gaps in this case, not just small ones. This chart is going to show you a couple of small ones. For those of you who are not familiar what gaps are, you can go to our free website at PerfectStockAlert.com. There's 4 different types of gaps, 4 different videos discussing them, and it's right there at our free website. You can check it out whenever you'd like. Right now I'm just going to show you what a gap is for those of you who may not know. This is just a situation where you've got a candlestick closes at one point. The following day, instead of trading down or trading up, it just gaps in that direction. Here it is gapped down, starts trading here the next day, leaving an unfilled gap from that close to the high of this candlestick. It's just unfilled. Here you've got a situation where the candlestick has closed, and then the following day she gaps up and starts trading in this range, leaving an unfilled gap at this point. These are too small to even consider trading them, but I'm going to show you an example now that we are looking for a much larger gap. Okay, here we are looking at Apollo Group, ticker symbols APOL. You'll notice that this stock has actually been trading down shortly, and then she gaps down substantially. This is a monster gap, something I really like to take advantage of here. You've got this candlestick closed at about 51.50. She gaps down the following day to 44. A monster move to the downside. So when you see something like that, a couple things are going to happen. Number one, people are going to panic and they're going to sell stock, and that typically results in another series of days to the downside. That's fine. What you want to do is go the opposite direction. Look for the fact that this thing has dropped so big, so fast, there's going to be a knee-jerk reaction, a counter-trend move within this situation here that will test the resolve of short sellers, and it will basically move to the upside here at some point and then either roll back over and continue going lower or continue higher. We would have to wait and see what happens, but eventually that will happen. So what we want to do is catch that trade, and so there's a particular way of doing that. I'm going to show you how to do that. This one right now is something that you definitely want to keep an eye on. It's a chart that I would be monitoring to find an opportunity to trade, and it's a short-term trade. You're going to have maybe 1 to 5 days in there typically, and you're going to trade that to the long side. But again, it's not time yet. We need to wait for the right signals. So let's go see what the right signals look like. Okay, here we are looking at Exide Technologies, ticker symbols XIDE, and you'll see that we had a close of about $4 a share, gaps down substantially to about 3.2, and it starts to move lower here. Real nice size unfilled gap right here. Really like that move. Now she started to move lower. Notice this series of events that happens. You get candlesticks that then start to sell off because people are panicking, and you'll notice that the candlestick highs 1, 2, 3 are all consecutively lower than each one. Until that changes, I'm not even going to consider being a buyer. On top of that, when she starts to sell off like this, I want to watch the candlestick formations. I'm looking for a particular formation. It tells me there's support there. That would be this guy. The hammer formation is the most trusted when it comes to possible reversals and things of that nature. So this is the first one I'm going to look for. If I don't get that and she just reverses on me and I get left behind, oh well, missed opportunity. I want to find the right setup with the right signals. Okay, so now we get this sell-off here and we get this hammer formation. I still don't buy, even though I see the hammer. I see the previous resistance was here. I can see why we broke out of it and why this resistance is now acting as support and why this hammer candlestick formation is telling me that there's support there. I get all of that. However, I still don't want to be a buyer until I see one more thing change. Let me clean that up. I want to see a series of higher highs and higher lows from one candlestick to the next. Here we have this high point gets taken out by this high point. This low point is now reversing. We're seeing a new low, a higher low than the previous candlestick. At this point, at the close of this candlestick, I'm interested in buying. Now, I'm not actually going to wait to the close of that candlestick because the next day stock may gap up on me and I'd miss that opportunity. So what I would do is I'd be watching it. It'd get close to the close of the day, about 5 minutes into the close, something of that nature, and I just buy it because the odds of it in the last 5 minutes zipping down here like this and taking a new low, not likely going to happen. So I'd be a buyer at the very end of the day and wait. Now, let me clean that up. What would have happened if I had a situation where you had the hammer formation? I like that. The following day's candlestick had a higher high than the previous. However, let's imagine that this candlestick also had a lower low than the previous. What would I do in that case? Not a darn thing. If it's not perfect, I'm not touching it. Wait. Okay, don't forget we have to always use a stop when especially when we're dealing with situations like this. The stop would be off of the low point. You got their low point here, 267, so I better stop at 266 right there and be a buyer on this close right there. And then the following day I'd expect her to continue to move higher. So the following day she moves up. That's fine. I'm going to take this stop loss limit that's right here and I'm going to advance it to the low of this day. The following day she goes higher. I'm going to take that stop loss limit and advance it to the low of that day. I'm going to keep doing this until I'm eventually stopped out. This is only something I'm going to be using for expected trade on maybe 1 to 5 days before I'll get stopped out using this model that you see before you. There are those that would be a buyer here, set a stop here, and wait for it to continue to just find its way higher. I'm not going to do that. And I understand when people do that, but that's not what I'm actually teaching here. This is more of a you'll get higher accuracy here if you only do the very short-term trade. Just think of it in the sense of making small gains every single week, compounded again and again and again, as opposed to buying some that will eventually rise and fill the gap, and then there's those that will actually come up here and then do this number. Let me show you an example. Okay, here's an example of a company that's actually got a really nice gap on it. Nice move to the downside here. Fills some of it the first day that it actually formed. That's what this wick out of the top is showing. Intraday activity comes up and fills about half of it. Then she sells off some more down here, and we finally start to get hammer formations. There's one here, and there's one here. Again, we have one actually kind of over here. It's a little wick out of the top, though. But again, the following day is what's important. Just because I see a hammer formation doesn't mean I buy it. I want to wait for a series of higher highs and higher lows. Let me explain the logic there and clean that up. Whenever you have a situation where you can get a higher high than the previous day, you're seeing a decrease in the selling pressure. There's an ability there for bulls to push higher when it had not been capable earlier. So this is something that I want to add to the requirement before I'll go buy. Just because I get a hammer doesn't mean I'm going to buy. Okay. So here we have a nice day that comes up here against a higher high, a higher low. Everything looks right. You be a buyer, and then you set your stop at your previous low point. You can use this one here, and what you see 3 days later, you get stopped out. It's going to happen from time to time. Don't kid yourself. Those stops are in place for a reason. Sometimes a major gap down is just the start of a major downtrend. That can actually get very, very painful over an extended period of time if you let it. So don't do that. Actually advance your stop, follow your rules, so forth and so on. In this particular case here, you've actually, because you were a buyer here, your stop was here, the following day she closed higher, you would have advanced the stop to this point if you were doing what I was talking about earlier, where you keep advancing the stop after each close of the day. So you would have been stopped at the following day at roughly a very small loss here, about 2.5%, maybe 3%, before she had moved much lower. And this could continue for an extended period of time. Now, once this situation has happened here, and I've taken my initial attempted trade, and I get stopped out, I'm no longer interested in trading this chart ever again. Not based on this gap, because I've already done that. I've already looked at this big move to the downside, expected a move to the upside. It's a counter trend, and that trade is strongest the first time it attempts it. The second time it attempts it, it's weaker. The third time it's weaker, and so forth and so on. So I don't want to get involved later on talking about filling some gap that we're not even dealing with anymore. Okay, we already moved on beyond that actual trade. Okay, here we have an example where the gap down the very first day, you notice that you had to close here. The following day, you gap down from about 10.25 and down to around 8.75, and you actually form almost a hammer formation on the very first day. Again, I don't want to be a buyer there. I want to wait until I get a series of higher highs and higher lows. The following day, you get that there and there. Okay, you can look at the high points of this candlestick, obviously higher than the high of this candlestick, low points of this candlestick, higher than the low points here. At that point, you could be a buyer. However, you need to be cautious in this situation, because when you're a buyer there, your risk is bigger because your stop is way down here. So that's something you need to consider. Do you want to actually make that trade or not? You may just want to say, let it go, but I'm not going to play. But if you do take this opportunity and say, okay, it's 40 cents, I'm going to trade this, I'm going to, or 50 cents, whatever it is, I'm going to be a buyer here and expect it to move to the upside. Remember, as soon as the next day closes, advance the stop from point A to point B, the very next point. You just keep advancing that stop as she goes higher and higher and higher until sooner or later you will be stopped out. You get stopped out here actually. You could actually continue to trade on the long side if you use a different model, but this is not the method that I'm teaching here. I only want you to be in this trade for a very short period of time. Like I said, 1 to 5 days is typically the extent of the move to the upside that you're going to have. And again, in a situation like this, something has occurred. Some news has hit the company, something that has caused this major gap down, and that's something that can continue to develop. So let's say, for example, that you see this opportunity, you say, all right, I like it, I'm going to be a buyer. And then you hold it, and then you decide, I'm going to hold into the weekend. Well, how do you know that news is over? Maybe more bad news is going to hit over the weekend. Well, what's going to happen then? Well, that stock that you bought and enjoyed and everything, it's going to gap down on you, maybe even lower. And now you've just turned a good gain into a really bad loss. So I really don't want to do that kind of stuff. Okay, this video is getting a bit long in the tooth. If you guys are looking to find opportunities where you can use this or deploy this method, what you want to do is find a scan engine that allows you to search for gaps, and you're not going to be able to for free. It's going to be difficult to actually tell them the size of the gap you want. But if you go to stockcharts.com, I use them all the time, been using them for the past 6 years. Up here I'm actually on them right now. You go to stockcharts.com, you can go to their homepage, and on there somewhere they have free scans. Let's see over here. Yeah, that's right. Alright, so they have free scans there. They don't give you every opportunity that's out there on a particular day or whatever, but they do give you some free scans, and you will be able to find actually, let's see, where are they at? Gaps. We have gap downs right here, and you have runaway gap downs, so forth and so on. So you can get these for free, and they cover US and Canada, I believe. So that's something you can look at. However, these are free. They don't, like I said, they don't show you every single one that happens every day, but they do update it every day. And then most of them are not going to be big enough that, you know, for what we're looking for. We're looking for really large gaps, and most of these will be small gaps, just because there's typically more small gaps than there are large gaps. For those of you who do have an account with stockcharts.com, you can go up there and you can actually write your own scan, or I'll write one and I'll put it on the website. You can just copy and paste it, drop it in there, and it will actually be a requirement for a gap of a certain size. Okay, so that way it would make it a lot faster, and you would get more scan results, so forth and so on. It does cost money to have a membership. I think it's like $35 a month or something, but it's been, you know, well worth the money for me for the past 6 years, so I definitely recommend it. Also, if you tell them Christian Williams sent you, I get a free month, and that makes me like you that much more. God bless, take care, and I'll see you in the next video. Don't forget to refer your friends to the free website. God bless. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.